Hi everyone and welcome to Module 7 or Unit 7. For this week you're going to be reading these following chapters. Make sure in your book that you focus on the chapter titles instead of the numbers, as it'll make it much easier to know what chapters we're covering because those are the titles we're looking at. Here's the watch section of the course, and in the watch section I have a lot of different videos that will help you prepare. And I think you'll be able to understand more when you look at these different videos. Now, we'll go over some of the key characteristics with some of these as well. And not key characteristics, I'm sorry. We're going to go over some of the questions as well. Let's go over the reflection first, because I think a lot of students have really liked this. I think it will help you. So now, a public good. When you look at a public good, you'll notice it's non-rival and non-excludable, which means everyone can consume a public good and don't have to pay for it. Question 2 is looking at an external cost of production. And an external cost of production is a cost that's borne by another person. Question 3 is looking at the free rider. And the free rider is focused on someone that enjoys an activity but does not have to pay for it. Public goods and services is not going to be paid for by any individual or person because they're going to be supplied by the government. Question 5 is going to be looking at adverse selection. Question 6 is going to be looking at this Harbor Lighthouse. And when you look at this lighthouse, you'll be noticing there's a lot of challenges we're facing. And with this lighthouse, there's going to be an example of a public good. Question 7 is going to be looking at the characteristics of a public good. And you'll notice public goods are subject to the free rider characteristic. Question 8 is going to be looking at a good that's non-rival in consumption. And when it's non-rival in consumption, that means that we do not compete to consume the good or service. Question 9 is going to be looking at private goods, and private goods are rival in consumption and excludable as well. And question 10 is going to be looking at asymmetric information. Now let's go over the accomplished task. With the accomplished task, you could get a range of questions, but make sure to take advantage of the 2 attempts as well. In question 1, it's looking at a firm that's forced to consider an external cost. And the price of the product will do what? If there's an external cost. So it's going to really influence the business. Question 2 is going to be looking at public and private goods and which one will be true or false, or which one's going to be true, I should say. Question 3, if the production of a good generates external benefits, that's going to be a positive externality because of the benefits. The government could help it out by having a subsidy. Private goods, you'll notice, are both rival and excludable because we can get people to pay for them. Public goods are goods that are paid for basically through tax revenues and by the government. And question 6, which of the following is not a way to overcome the free rider problem? So a way to not overcome the free rider problem is looking at when you can get people to pay for what actually they consumed. And that's a very big challenge sometimes. Question 7 is looking at taxes on external costs are unlike other taxes because why? What are external costs and why are they different than other taxes? Question 8, insurance has a high deductible and the driver will pay more damages. Asymmetric information suggests that what? If I have to pay a high deductible and I'm stuck with this high deductible, I'm going to have to sacrifice and make sacrifices because I'm going to be the one stuck with most of the bill at the beginning. Question 9, consider a market in which some high quality goods are sold, but not as many as if there were perfect information. So when information is not perfect, what is that known as? Question 10, if a producer is imposing an external cost. So if it's a cost, it's a negative externality. So we need to somehow internalize or tax the situation that's occurring. Question 11 is looking at adverse selection. Question 12 is looking at public goods, and public goods are both non-rival and non-excludable, so everyone can consume them without having to pay. Question 13 is looking at moral hazard and the situation that moral hazard brings about. Question 14 looks at this table right here and looking at, as buyers adjust their expectations of lemons in the future, what will occur? So numbers of lemons supplied, numbers of plums supplied. Buyers assume chance of a lemon. You assume you're going to get more lemons. So now if we assume this, what will happen to the prices? Question 15 is looking at taxes on external costs, which is a negative externality, and how taxes will influence it. Question 16 is looking at public goods. When you have external benefits, how does that occur when you have external benefits? With public goods, when you have benefits, you want to be able to supply more of that. 17 is looking at how consumers evaluate cheaper and more expensive products. Question 18 is looking at command and control economies that have a pollution tax. So a pollution tax is only going to tax a specific good. 19 is going to be looking at a private market, does not provide national defense. So that means if there was private defense, that means I would be supplying defense for specific individuals. And if I didn't pay for public defense, they wouldn't defend me. But that's very difficult with national defense. And then the self-interest theory of government looks at what? So those are some of the questions that you could get. Make sure to take advantage of the 2 attempts, though. I think that'll really help you out. And review your answers as well. If you have any questions, please let me know. But I look forward to your effort this week.